Stop scrolling for a second, because something just happened in the metals market that most people will only understand after it's already too late. Silver didn't just move up. It blasted through levels that were supposed to take months, maybe years, and it did it with the kind of energy that makes you ask one uncomfortable question. Who was positioned before the crowd noticed? And if you're here thinking, it's just another spike, I get it. The internet is full of hot takes. But this week's action isn't just a chart story. It's a power story. It's a policy story. And it's a story about what happens when confidence cracks in public, while demand quietly shifts behind closed doors. So, in this update, I'm going to walk you through the biggest catalyst that pushed gold and silver into another record-setting stretch, what's really driving silver above the low 90s, and why the next chapter might be even more volatile than the breakout itself. And yes, we'll talk about politics, central banks, supply chains, and the invisible market mechanics that most mainstream coverage never explains. But first, a quick reality check. My channel stats show that a huge chunk of people who watch these videos regularly still haven't subscribed. If you get even a little value from this kind of breakdown, hit subscribe right now. We're aiming for 50,000 subscribers in the next 30 days, and your single click makes a bigger difference than you think. Also, we're now posting members-exclusive videos on a regular basis, and this isn't recycled content. A dedicated team is working behind the scenes to build these deep dive updates only for you, our special members, and the John AG family. If you want in, click the join button right now, or use the link in the description. All right, let's get into it. Gold and silver just wrapped up another week that felt like a pressure cooker. Economic uncertainty didn't calm down. Geopolitical risk didn't fade. And the market didn't get the clean, comfortable narrative it wanted. Instead, the metals did what they usually do when the world gets noisy. They moved. Gold pushed decisively above 4,600 per ounce on January 12th, and it's been a good part of the week holding that territory like it belonged there. And silver? Silver went for the throat. It surged past 90 per ounce, and then it didn't stop. On January 14th, it punched through 93, a level that turns heads even for people who don't normally care about metals. Now, whenever prices jump like that, everyone rushes to explain it with a single neat reason. One headline says it's inflation, another says it's war, another says it's technical buying, another says it's panic. The truth is, moves like this don't happen because of one factor. They happen when multiple forces line up at the same time, like dominoes falling in the same direction. So instead of pretending we can cover every possible driver in one video, I want to focus on the catalysts that dominated the conversation this week. The ones that actually change sentiment in real time. And then I want to zoom in on silver specifically, because silver's behavior right now is sending a message that gold isn't sending in the same way. Before we go any further, check the description. I've put bonus links down there for you, including a premium WhatsApp channel link and a channel membership link, so you can get updates and deeper dives without waiting for the next upload. Take a look after the video, because those resources are built for people who actually want to move ahead of the crowd. Now, let's start with a headline that hit like a thunderclap. A public clash between the President of the United States and the head of the central bank is not something markets shrug off. And this week, that clash escalated in a way that dragged the idea of central bank independence right into the spotlight. On January 11th, the central bank chief said that 2 days earlier, the Department of Justice served the institution with grand jury subpoenas, with the implication that criminal charges could be on the table. Let that sink in. Whether you love or hate the people involved, the signal to the market is the same. The guardrails are being tested. And when the guardrails are tested, investors don't just think about policy. They think about stability. They think about what happens next. Now, officially, the issue was described as being connected to a renovation project for a major government building. But in the market's mind, the story quickly became something else, because the timing matters. The pressure to lower interest rates is a constant theme in political messaging. And when you combine that pressure with legal threats, investors start asking a question that never shows up in official statements. Is monetary policy still about data, or is it about control? I spoke with a market commentator shortly after those remarks went public, and his take was blunt. He believed the legal pressure was a tool to force rate cuts and to reshape the central bank leadership. Again, that's an opinion, not a verdict. But the market doesn't wait for a verdict. The market trades the perception. And the perception right now is that the next leader at the central bank, whoever that ends up being, will be more aligned with the administration's preferences. That matters for metals because gold and silver tend to benefit when interest rates are expected to move lower, or when the credibility of policy gets questioned. Lower rates reduce the opportunity cost of holding metals, and doubts about independence increase the appeal of hard assets. And even if you think rate cuts won't happen immediately, the shift in expectations can move price today. Now, the president publicly said he had no knowledge of the investigation and claimed he wasn't interested in removing the central bank chief, whose term ends in May. But markets aren't trading his statement. They're trading the reality that the political temperature is rising. And if the temperature keeps rising, the metal markets don't need permission to keep climbing. Now, that political storyline would be enough on its own to add fuel, but it wasn't happening in a vacuum. At the same time, geopolitical tensions stayed elevated, and the word intervention started popping up more often than people are comfortable with. Venezuela remained in the spotlight after last week's dramatic change in leadership, and the ripple effects still haven't settled. Meanwhile, the administration warned that if executions tied to anti-government protests in Iran did not stop, the United States could intervene. Iran responded with a threat of striking U.S. bases if that intervention happened. You can disagree about the politics, you can debate the probabilities, you can argue about media framing, but the market hears one thing: escalation risk. And when escalation risk rises, safe haven demand rises. Gold benefits from that, almost by reflex. Silver benefits too, but silver often does it in a more chaotic way, because silver wears two hats at the same time. It's a monetary metal in moments of fear, and it's an industrial metal in moments of economic transition. That dual role is one reason silver can look calm for months, and then move like it's been released from a cage. So yes, geopolitical headlines added support. But if we stop the analysis there, we miss what's unique about silver right now. Because silver isn't just reacting to fear, it's reacting to structure. And that brings me to the next factor that quietly hit the market this week: critical minerals policy. The U.S. government signaled that it plans to delay new critical minerals tariffs after reviewing the results of a trade investigation launched last year. A presidential proclamation stated that imports of processed critical minerals and related products pose a national security risk. But rather than immediately slapping on new tariffs, the plan is to start with steps like negotiating supply agreements with other nations. Here's why that matters for silver. Silver was recently designated as a critical mineral in the United States. And when a material gets labeled critical, it changes how policymakers talk about it, how companies plan around it, and how markets interpret its future. Some traders believe the tariff delay contributed to a midweek dip in silver because immediate policy action didn't arrive the way some expected. But that explanation is only the surface, because even if tariffs are delayed, the underlying message remains. The U.S. is worried about supply security. And the moment a government worries about supply security, the market starts thinking about stockpiles, strategic sourcing, and competition. Those are not short-term themes. Those are multi-year themes. So the bigger question isn't, did tariffs happen this week? The bigger question is, does this accelerate a broader scramble for control of supply chains? And if that scramble accelerates, silver's price doesn't just respond to investor sentiment. It responds to industrial procurement. It responds to manufacturers trying to lock in supply. It responds to entities that don't care about charts because they care about production. Now I want to talk about the elephant in the room: physical delivery. Because if you follow silver closely, you've probably noticed a shift in the way people talk about it. For years, silver discussions were dominated by futures contracts, paper trading, and endless debates about manipulation. But recently, more attention has turned to something simpler and more important. Who actually wants the metal? A metals market participant I spoke with emphasized that a growing number of large, well-funded players are choosing to stand for physical delivery instead of rolling paper positions forward. And according to him, this behavior has been accelerating since 2020. He described it as unusual because historically, most players treated futures markets like a casino where no one actually picks up the chips. They place bets, they hedge, they settle in cash, and they move on. Physical delivery, especially in size, changes the game. Because when enough players demand delivery, the paper market can't pretend inventory doesn't matter. And the most interesting part of his observation was that he believed the trend expanded beyond the places where people traditionally expect it. In other words, it's not only outside regions that are pulling metal. He believes major North American participants are now stepping into the delivery process in a way that's hard to ignore. And if that's true, it raises a question that should make every silver watcher sit up. If the biggest, best-funded players are insisting on physical metal, what do they see coming that the average investor doesn't? That question isn't meant to scare you. It's meant to wake you up. Because markets often tip their hand through behavior, not headlines. Now, some mainstream commentators still talk about silver like it's a joke, like it's a niche hobby for conspiracy forums. But when delivery behavior shifts, the joke stops being funny. Now, here's a quick creative detour, because I promised you this. If you want to hear silver-related success stories, real stories about how people built wealth, made smart moves, and turned conviction into results, there's a link in the description to another channel that focuses on that angle. Go check it out and subscribe over there too, because it can be motivating to see how others actually executed, not just what they believed. All right, back to the main plot. We've covered politics, geopolitics, policy, and delivery, but we still haven't answered the biggest question. Why did silver break 93 specifically, and why did it do it now? Because price levels aren't magical, they are psychological, they are crowded. They are where stop losses sit and where breakout buyers get triggered. When silver pushes through a major level, it often triggers a cascade. Short sellers get forced to cover, momentum traders pile in, options activity shifts, algorithms flip from selling to buying. But here's the twist. That cascade only sustains if there's real demand underneath it. And the market is trying to figure out whether the demand under this move is durable. This is where the story gets spicy. Because silver is not only breaking out on the screen, it's breaking out inside a macro environment that makes those breakouts harder to stop. Let me explain. When the public starts losing confidence in normal, money flows differently. When politics is loud, capital seeks shelter. When geopolitical risk rises, capital seeks liquidity and safety. When supply chains look fragile, companies seek inventory. And when rates are expected to fall, investors seek alternatives to cash and bonds. Put those together, and you get a powerful cocktail. That cocktail doesn't guarantee a straight line up. It guarantees volatility, and volatility is the oxygen of big moves. Now I'm going to pause here and ask you something directly. Do you think silver can hold above 90 for the rest of this year? Or do you expect a sharp pullback that shakes out late buyers? Drop your answer in the comments because I want to see whether the community is leaning breakout and run or breakout and trap. And while you're down there, if you're someone who has already been successful, whether you built wealth in metals, in business, in investing, in anything, share a piece of your success story in the comments. Not to brag, but to help. People read those comments, and seeing someone else win can raise the morale of someone who's still trying to figure it out. Now, we need to circle back to that central bank drama, because it connects to something bigger. When legal threats and political pressure surround monetary leadership, investors start thinking about the future path of rates. If the market believes rate cuts are more likely, it changes the entire discount rate logic across assets. Stocks can pump. Real estate can reprice. Long-duration assets can get a second wind. But metals can do something different. Metals can re-rate as trust assets. Not because they pay a yield, but because they don't require a promise. And when trust is the scarce commodity, assets without promises become valuable. Now, I'm not saying the world is ending. I'm saying the narrative of stability is being challenged in public. And that's enough to keep the bid under metals. Now, here's where I'm going to lay down a cliffhanger. Because if you think the last week was intense, the next few weeks could be even stranger. Why? Because the market is approaching a moment where multiple decisions converge. Leadership changes at the central bank are approaching. Policy debates around critical minerals are escalating. Geopolitical flashpoints are not cooling off. And silver, unlike gold, is sitting at a point where the physical story can collide with the paper story. When those collide, price can gap. And when price gaps, people who waited for confirmation get left behind. So what should you do with that information? First, don't let emotion drive your decisions. Second, don't let headlines whipsaw you. Third, get educated, because the better you understand the drivers, the less you panic when the market moves. That's also why the membership option exists. We offer members-only videos where a separate team is working specifically on deeper research, tighter data, and more detailed breakdowns. Those videos are not just longer versions of the public content. They're built differently, with more context and more careful sourcing, and they're only for premium members. If you want that extra layer, the membership link is in the description. Now, I want to bring this back to silver above 93 because the number matters psychologically. When a market prints a fresh milestone, it forces people to update their mental model. A lot of investors anchored their expectations to old ranges. They remembered silver as the metal that never goes anywhere. They remembered it as the metal that always disappoints. They remembered it as the metal that gets hyped and then dumps. But those memories are not the market. They're just stories. And this week, the market wrote a new story. So the question becomes, is the new story sustainable? Let's break the sustainability question into 3 parts. Part 1 is macro. If uncertainty stays high and rates are expected to move lower, that's supportive. Part 2 is policy. If critical mineral strategy pushes companies to secure supply, that's supportive. Part 3 is physical. If delivery demand continues rising, that's supportive. Now, notice what I did not include. I did not include hope. Hope is not a driver, it's a feeling. Drivers are measurable. Drivers create pressure. Drivers show up in behavior. Now, there's another subtle driver that sometimes gets overlooked. When silver runs, it forces a conversation about currency. Gold is often framed as an alternative to currency. Silver can be framed that way too, but it also shows up in everyday manufacturing. So when silver gets expensive, it's not just investors paying attention. It's industry. It's procurement managers. It's energy technology. It's electronics. It's the whole chain that depends on the metal. And when those chains get stressed, governments pay attention too. That's why the critical mineral designation isn't a random label. It's a signal. Now, I want to do something that mainstream coverage rarely does. I want to connect the dots between the political story and the silver story without turning it into a rant. If leadership pressure makes markets think rate cuts are coming, that can increase risk-taking. Risk-taking can lift commodities, but it can also lift industrial demand because companies anticipate a more supportive environment. And if industrial demand rises while investors also want silver, you get a squeeze. Not necessarily a Hollywood-style squeeze, but a real-world squeeze where inventory becomes more valuable than paper. That's why the delivery chatter matters so much, because it's a sign that some players are no longer satisfied with exposure. They want possession. And when the market shifts from exposure to possession, price becomes more sensitive. Now, let's talk about the midweek dip, because dips are where people reveal who they really are. When silver dipped midweek, some people celebrated, claiming it proved the move was fake. Others panicked. Others bought. A dip after a breakout can mean two things. It can be a healthy retest, where price checks the breakout zone and then moves higher. Or it can be a rejection, where the breakout fails and price falls back into the old range. The difference is not decided by one candle. It's decided by follow-through. It's decided by volume. It's decided by how quickly buyers step back in. And it's decided by whether the fundamental drivers remain intact. So if you're watching this and you felt your emotions spike during that dip, you're not alone. The market is designed to mess with your head. That's why having a plan matters more than having a prediction. Now, I want to zoom out and give you a bigger perspective. In the metals world, every rally has two fights. Fight one is against skepticism. Fight two is against leverage. The skepticism fight is social. People don't believe. They mock, they dismiss, they call it a fad. That fight often ends when price forces them to respect it. The leverage fight is mechanical. As price rises, leverage grows in the system. Options, futures, margin positions, and speculative bets expand. That leverage can accelerate gains, but it can also amplify corrections. So the healthiest rallies are the ones that build with real demand underneath, not just leverage on top. Now, I can't see every position in the market, but I can see behavior. And the behavior being discussed right now, more physical delivery, more policy focus, more geopolitical tension, more rate debate, those are ingredients that can support real demand. Which brings us back to the question everyone keeps asking. What's really driving the price? Here's the cleanest way to say it. Silver is being pushed up by a pileup of stress. Stress in politics, stress in global stability, stress in supply chains, stress in market confidence, stress in expectations about rates. And when stress piles up, hard assets become attractive. But silver also has something else, consumption. Gold mostly sits. Silver gets used. So when investment demand rises on top of industrial demand, price can jump faster than people expect. That's why silver can be boring and then suddenly violent. Now, let's be honest about risk, because I never want you to think I'm here to sell you a fantasy. Silver can correct hard. It can drop quickly. It can shake you. It can test your conviction. And if you don't understand that, you'll get emotionally whiplashed. But corrections are not the same as collapse. A correction can be a reset that sets up the next leg. A collapse is when the underlying story breaks. So the real question you should ask is not, will it dip? The real question is, does the underlying story remain intact when it dips? That's what separates noise from signal. Now, I want to add another friendly nudge about success stories. If you're one of those people who made a smart move early, or you changed your financial trajectory in any way, share one lesson in the comments. Maybe it's how you controlled emotions. Maybe it's how you learned to hold through volatility. Maybe it's how you avoided scams. Maybe it's how you built a system. Your story can help someone else. Now, if you're still with me, here's another cliffhanger. There is a point above 93 where silver doesn't just trigger technical traders. It triggers a new kind of buyer. It triggers the buyer who has been waiting for proof. And that buyer doesn't care about your arguments. They care about the fact that price is making history. If silver pushes further and holds, you'll see a wave of proof buyers enter. And that wave can be powerful, but it can also be emotional, which means it can overshoot and then correct sharply. So again, plan over panic. Now, I want to do a quick check-in with the community. Have you personally noticed more people in your circle talking about gold or silver lately? If yes, tell me in the comments what you're hearing. Are they curious? Are they skeptical? Are they suddenly bullish? Or are they only paying attention because they saw a headline? Those little observations matter because they tell us where we are in the attention cycle. Now, a quick reminder, because I promise to keep this reasonable. If you want the deeper dives, members-only videos are available through the membership link in the description. A separate team is working on those, and the research is heavier than what I can fit into a weekly public update. It's meant for people who want more than headlines. And if you're not ready for membership, at least check the bonus links in the description, especially the premium WhatsApp channel, because it's a quick way to stay connected between uploads. Now, I'm going to close with a direct message. If you've watched this far, you are already more informed than most people who will talk about silver this week. So don't waste that advantage by staying unsubscribed. Hit subscribe, help us reach 50,000 in the next 30 days, and keep yourself plugged into updates that cut through the noise. Also, check the description for the bonus links, including the premium WhatsApp channel and the membership option. And remember, members-only videos exist for a reason. Deeper research, a separate team, and content that's built for people who want the full picture. Now, here's the final cliffhanger. If silver can hold above 93 and then push higher again, the next round of headlines will be even louder. And the question won't be, what happened? The question will be, who saw it coming? Don't be the person who only understands the story after the price already moved. Be the person who learns the drivers, watches the signals, and stays ready. Leave your thoughts below, answer the questions I asked, and if you've had success, share it with the community. Stay sharp, stay calm, always. I'll see you in the next update.